Now here we have on 1st November the opening stock of 300 units which we have at 36,000 rupees. On 10th November a batch of 400 came in, as we saw, at 125 rupees. So that is valued at 50,000 rupees. So balance in stock is 86,000 rupees and the total that we have is 700 units. Dividing 86,000 by 700, you will get an average cost of 122.86. On 14th November, a sale of 500 units out of this 700 has happened. So 500 into the average cost of 122.86 is 61,429. So this is the issue cost. So out of 700, if 500 goes, the balance stock now is 200. Now on 20th November, a further purchase of 400 has happened, and that happened at 140 rupees, as we have already seen. So what is the purchase price now is 56,000 rupees, and your balance stock is valued at 24,571. So your total value of the stock is 80,571, and this is spread over total of 400 plus 200, 600 units. So your average cost is now reworked to 134.29. And on 21st November, subsequently a sale of 500 units happened. So we held 600 units, out of which 500 units were sold at the average cost of 134.29, giving us a value of 67,143. So that was the issue price for this lot of 500. Now balance stock is 100 left, and on 25th then again 400 was purchased at 150. So old stock of 100 was held at 1344.29. The new stock came at 60,000. So the total is 73,429, and the total stock, total number of units is 500, which you, when you divide by 73,429 by 500, you get a average price of 146.86. And then subsequently on 28, you sold 100 at this average cost. The issue price was 14,686, and the balance stock is now valued at the same average cost and valued at 58,743. So this was the issue cost of sale that happened, and this is the closing stock figure. So you can see that there is a reworking every time a new stock comes in and the average cost is reworked. While in the FIFO method, we just went into the sequential thing of as what came in first is what we assumed has gone out first. Now let's look at the difference in the profits between the two. So the opening stock was same in both cases, that is what we assumed, which may not be the situation in reality, because we will see that a little later. So opening stock was 36,000 in both cases. Add the purchases that happened during the year, which is 166 in each case. Okay. So the total stock in hand is 2,02,000. Now the less the closing stock, we remember we worked out closing stock as per FIFO was 60,000 rupees, while as per the average cost method was 58,743. So the cost of sales therefore is 142 as far FIFO is concerned, and 143,257 as far AV average is concerned. So the sales was 1,100 units at 200 rupees, giving 2,20,000. So the profit in FIFO works out to 78, while in average works out to 76,743. So that is how you value the issue price. The issue price itself will the methodology that is used will also give you different profit figures. This is something that we need to understand. As I was saying before, remember this opening stock now we are valued at assumed to be same, but if you look at the usually what will happen, the method that you have used will also determine what is your opening stock. For example, this closing stock when becomes next year's opening stock, you will find that the two methods have different opening stock figures. So the way you look at the valuation of your stock, the issue price of your stock also determine how the profit figures change. So this is something important that we need to understand and keep in mind while profits are being looked at from a buyer business, and you maybe as an external user or an internal user are understanding to see how stock is contributing to the profit figure. So, the last part of our session where we understand is what happens, how do we account for stock. So, once the stock taking is taken, we have the stock figures, and based on that we can pass the accounting entries. So, basically we need to arrive at what is the cost of goods sold essentially. So, in a P&L ledger account, we know that already, we have learned this before, that to bring it the sales figure into the P&L account, sales had a credit balance, so we debited sales and credited P&L. So, the sales figure is already available to you. Now, the cost has to be brought in here. So, transfer the purchases, what we do, we have done this before also, debit P&L and credit purchases, so that the purchase balance will come here. All income and expense accounts, as we have you may recall, we have done this session before. All when you have to create the profit and loss account, all the income and expenses account either with debit or credit balances are done the other way around, that is, they are debited, debit balances are credited, credit balance are debited, and they are moved to in one place called the profit and loss ledger account, where the balances are available. So, that in that process purchase and sales would have come here, but we now need to do the cost of goods sold exercise, which means add opening stock. So, when you want to add opening stock, you will debit P&L and credit with the opening stock value. You have done a stock taking last year, and that opening stock, that becomes opening stock value, that opening stock value you bring in. So, purchases, whatever you have purchased during the year, and opening stock have come together. This is the total value of stocks that was available for sale in for that particular business. But there is also a closing stock figure that we need to adjust, because this was not the whole amount of sale. There is some closing stock that has been left. So, we need to move that amount back into the stock item, that is in your stock account. So, you will debit stock account with the closing stock value and credit P&L account with the closing stock value. So, you will have debit to the stock account with the closing stock value and a credit to P&L account. Effectively, if you see, whatever the cost of goods sold formula that we had learnt is effectively brought in here, where the sales plus closing stock will give you the total credit balance. If it is higher than the debit balance, which is your purchase and opening stock, effectively showing you what the gross profit figure is, and thereby arriving at the figure. So, this is how the stock accounting is done to ensure their gross profit is brought in line with what you have understood conceptually in the beginning. So, this is kind of comes to an end. Overall, we have understood how stock has to be treated in the books, what are the nuances in valuation of stock, what are the nuances in issue price, how they can affect the profits based on how the issue price is valued, how the market or the net realizable value of the stock is taken, etc. So, that gives you a fair input to understand the nuances of how stock can affect profit.